Hey, welcome to the Daily Stock Review. Today we're going to go over 3 stocks, and the aim of this channel is to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months. If that sounds good, subscribe to come along. Who am I? I'm Jack. I'm an individual investor. I'm on the journey, just 2,500 hours in over the last 7 years, sharing the lessons along the way. This is my investing process. Today we'll cover and I'll show you guys how I'm sourcing these stock ideas and the 5-minute check that we're going to do on each one of these stocks today. These are the guys I learn off. They did pretty well for themselves over just a little while. And by following the breadcrumbs that they've left behind, we should be able to follow in their footsteps. These are the investing resources that I put together. They're free. It's what I wish I had when I first started. You can grab those with the link in the description. And otherwise, let's get into it. All right, so we've got 3 stocks. Today I've used a screen. I'm still going through some small caps, and I've just started from the top of the industrials. What I'm looking for is anything with sales growth or revenue over 30% over the last 3 years. And so that should find some pretty nice growth companies. Now I've been through this list and nitpicked a couple of stocks to go through first of all. I've already covered American Superconductor. For instance, they had some really strong margins that look like they came through. Now I'm just checking the rest of these just to make sure that some of these values, if they've calculated correctly or not. So otherwise, yesterday we covered Acacia and Aero. Today we're going to go over Amprius, skip that one. We're going to go over the ticker Bayer, which is Bridger Aerospace Group Holdings, and BTOC, ticker, which is Armlogi Holding Corp, with the remainder of these going through later this week. All right, so that's how I'm sourcing these ideas. Next step in my process is pretty much grab the annual report and don't muck about. So we want to do a 5-minute check and screen the stock initially just to see if it's worth looking into further. Now, it makes it pretty easy with what I guess my end goal is. If you're just trying to find a bunch of stocks that you're interested in, sure, just go through and look at its sector and then pick out from there, but I'm trying to find the best, so it makes it easier to screen for that. Just more time consuming. So Amprius Technologies, if I want to find the annual report, all I do is type Amprius annual reports. Get this website for these guys. I want their latest 10K, which is here. I'm going to crank that open. And it's American based. I want to look for the financial statements. And I want to look at the income statement first. So what do we got? We got revenue, 24 million to 73 million. So pretty good. Cost of revenue. So gross profit was a loss that previous year, and they've started to make a profit on that this year. All right, what else can we see? Loss from operations, pretty significant as well. So bit of money in research, development, selling in general, and net loss. So net loss has pretty much been the same across the years, even with the increase here in revenue, which is 3x'd. What else can we see? What else is going on? So made a net loss. That's, pretty much what the screen told us. We're trying to look for things that are uncovered or hidden here. So cash equivalents, a fair bit of cash on hand, 55 to 90 million. Up over the years. And then we've got operating lease liabilities, and that's it for non-current. So they don't have any debt, which is nice. So it's a pretty healthy balance sheet. We want to see total assets more than liabilities, and even better is all the cash that they've got on hand in cash equivalents is able to pay for all their liabilities. So say for instance, if this business was in a bit of a pickle and the stock price pretty much collapsed down to nothing because people thought it was going to go bankrupt. Well, if we kind of looked here and we're able to sum up and say, well, actually, even if it does go bankrupt, they've got enough cash on hand to pay everyone back and still survive through it. So, it would be less risk and much higher payoff. All right, let's go and have a look at the cash flow statement now. So at this stage, the business isn't making any real gross margins, so it doesn't have much of a moat, competitive advantage around the business. Usually you can see that because the business has been able to establish itself, master its customer by making more revenue. And by the time you can master your customer, you can usually get to the stage where you can have a really great product and you can increase the price of it so that you can make some really good margins, and still the customer feels that they're getting value for money, which is the deal at the end of the day. But these guys, they got a way to go to get to that stage before it's kind of met an equilibrium, and they're still not making money at the end of the day. So let's just see if management's rational, just so you guys get a bit of a feel for how I do it. At this stage, I would have said no to this business already. It might get better in the future, but we might see it then if it turns a corner. So in the cash flow statement, we have the net loss, or usually net income, at the top, then get some non-cash charges adjusted to it. And we can see net cash from operating activities is still a negative, so it's a loss. So they're burning through about 33 million. They've also got to put money into property, plant and equipment, this would be their capital expenditure, and to pretty much look after their current assets. And so overall, we get a free cash flow is our net operating activities minus our property, plant and equipment. So in short, we end up with about 36 million dollars in negative free cash flow. So that's how much money is required pretty much over these last 2 years just to keep the business afloat. All right, what else can we see? Proceeds from issuance of common stock. So how are they actually financing the business? Well, they're selling common stock, which has given them 33 million the year before, 63 million this year. Proceeds, and so that's how they're financing the business at this stage. So this may be a business for me to come back to in future years and have a look at. At this stage, you can get wrapped up in the hype of the stock going from $1 up to what we at, 20, and calling it a 20x. But if the business isn't making profits over the long term, it's going to react to its value and come back down, and then you're exposed. So I'm going to say no to Amprius at this stage. It's pretty speculative. It would be a small, if you were investing in it, this would kind of be in the stage where, since it's not making any money, it's still chewing through 33 million in cash flow every year. It's kind of sitting in that speculative part of the portfolio where you might put 5% of your whole portfolio to the side, and that can be a small amount that you put these little 0.5%, 1% bets on whatever. But that's up to you guys. Let us know if you guys are checking out Amprius Technologies, or you guys have been long for a while. Otherwise, no harm from me. I just won't be coming to them until a little bit later down the road. All right, next one, Bridger Aerospace Group Holdings. So Max, looks like it's been around since 2021, or at least on an exchange, potentially. Pretty odd, this kind of on our graph, so I'm not even going to bother looking back on the history of it. But she's had a pretty ordinary trot. 87% down over, what, that was 5 years. Now, like I said, want to jump into the annual report. We got a 10K. Let's crack him open. Dum, 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 dum. All right. Fuck yeah. Let's go to financials. And we got the balance sheet again. I don't care. I want income statement. Now, what can I see? So we've got revenue growth from 98 million up to 122. So that's pretty good. Cost of revenues is 57 to 71. And then we've got gross. Oh, that's nice. So maintenance costs have gone up, which has wiped out, that extra revenue that we would have, or this company would have got this year. My background in maintenance, they totally fluctuate and depends on, what breaks and things like that. But we can expect maintenance to be a little bit lumpier across the years. And so we might want to go back to 2023, 22, etc. to see what's going on there and get a better estimate for the future. But gross income, otherwise, that's a pretty good margin. So, 40% there, pretty much another 40% gross straight away. Nothing to laugh at. Net income, so there's still some additional selling in general that's pretty much stayed flat, hasn't grown. Interest expense and other income. So this other income this year has actually allowed them to have positive net income of 4 million versus the previous year. Looks like they got pretty income loss before income taxes, so they'd already lost money by there. So they had minus 15.5 mil. All right, so that's where we're at there. Let's have a look at the balance sheet and just see if this business is worth moving forward on. So, going back, already, it's really nice to see revenues increasing. That can always be a really good story. Really nice to see that management hasn't started blowing out these administrative costs and things like that. Flight operations, other costs that go on, haven't really increased except for this maintenance one, which, like I said, it can fluctuate over time. So pretty steady here in terms of costs, and then revenue increases. So I'd want to see what the trend of that looks like. Now, net income though, and with the money coming from other income, even if we don't look at that, it's a 4% net income at the end of the day, which is, pretty ordinary. Now, if the story of this was that we go back and see this is continually growing, and we can see that this stock, the more money they get on, the more money that's going to trickle through and hit the bottom line, that would be a really good outcome. Let's have a quick sticky beak at PE ratio 0. We've got a market cap of 73. That's more interesting. Here we go. Show what are we currently trading at? $1.25. Nice, Gary. All right. So what does that mean? So this business, if it's making any money, we just want to see how much cash this thing produces, because we can get a pretty good out as long as this looks all right. This may be an interesting value play. Won't be hitting into our 100 bagger kind of category. At this stage, it's highly unlikely. So cash equivalents, 31. We've got property, plant, and equipment. Looks like it's a very asset-heavy business. Current liabilities, total liabilities, 265. Now, long-term debt, net of debt issuance costs. All right. So I do have a fair chunk of debt. So, this is going to be one that you really want to keep a good eye on to see if the business has enough cash flow coming in to pay for these future payments of the debt. So repaying the interest plus repaying the principal back when it's required. So if you're looking at this business and or you currently own it and you're looking long term, you're not just holding it for short term, you'd want to be looking at these kind of figures. So are they going to be able to pay it back by a certain amount, certain time, or be able to refinance it and things like that? And you can have a look at the notes to the financial statements, which is after this part of the report, to get a bit of a handle on when those kind of payments are going to come due. All right. So I'm not really impressed with the amount of debt the business has. Like, it'd be nice if it was low asset heavy. It just means the business needs to invest a lot into growth, or invest a lot in order to get growth. So here we go, cash flow statement. What else? We've got fair whack of adjustments. Net cash provided by operating activities. We've got 9 mil and 16 mil. And then what happens here? So previous year they had to spend 4 million on property, plant, equipment. This year they've proceeds from sale leaseback transaction, 46 million comes in, and then purchases and improvements of property, plant, and equipment. So they've had to spend 80 million. So now we're looking for $34 million. So 16 mil came in from cash. We don't have much free cash flow, and it's obviously fluctuated a fair amount in those couple of years. So it makes it a bit trickier to obviously see it straight away, like how much free cash flow are we talking, like long term, especially when we've only got 2 years to go off here. How are they actually financing the business? So proceeds from issuance of term loans is 220 million, and then repayments on debt, and then issuance at costs for term loans. So that's just paying the bank. Proceeds from payment of issuance costs. Yeah. So paying whoever's given them that cashola. It's obviously organising 220 million comes at a cost. So organising all that. All right. Kind of not too interesting. So like if this business was throwing off a heap of cash and it didn't have to really invest too much of it, this would be a really cool business to have a look at in terms of it's going to be punching cash out everywhere. Now, the business is loaded up with a fair bit of debt, and the business makes, we're talking like 10 million in cash. Roughly, 4 or 5 million of that needs to go over here, so it's left with 5 million. Now, a usual kind of ratio here would be like, cool, it's got a market cap of 73 million. We're talking like 5 million in cash a year. Conservatively, times that by 20, which is also pretty conservative. We get to 100 million. And so it kind of, if the business has long-term growth prospects, it might be interesting to look at, but not at this stage. There's still too many things going wrong. Do I think that it's going to go bust and go to zero? I don't think so. The balance sheet looks fairly reasonable just on that quick glance that we've had a look at. The business is still making money. Even if the net income looks pretty ordinary, it's still making cash at the end of the day. But it does need to invest that cash back in the business and pay off this debt. So, we'll see. All right. What else have we got? Logi Holding Corp. Hang on. I think I've got a delivery. Alright, so Logi Holding Corp, which has got a BTOC ticker. So we'll have a sticky beak at this. So it looks like it's had a pretty rough trot. It's got a 94% decrease in price over the last 5 years. If we enhance, we get, it's pretty well traveling sideways. So let's have a sticky beak at the annual report. Logi Holding Corp annual report. It's on the SEC, so the website didn't come up automatically. Sometimes that happens. Yeah, Armstrong Logistics. Woo! Alright, come on. Let's find the financial statements. Man, what are my eyes doing? I can't see. Ownership, management, other important information. Hang on a second. This is not what we want. I want the 10K. Alright. We're gonna have to try this a little bit more old school. Alright, so go Logi, go investor relations. Whoa. Nope, English, thanks. Alright, SEC filings. Alright. Ooh, well, you're just tricking me, were you? Alright, category, annual reports. So it should be up for a new one soon. But notice that there's always a 1 in, probably about 1 in 50 where it doesn't come up with the website or the actual link to it. So must be something going on with Logi's, crawl of their website and whatnot. So we've got the 10K for last year. Now I want to have a sticky beak at the financials, as we've done with the others. Let's have a look at this income statement. Revenue, cost of service, gross loss, profit, general and administrative, that's gross. All right, so the business has increased revenue. Awesome. However, it has not made any more money, and it has actually made a loss on the gross. So there is no gross margin here, so they've had a rough trot. Now, if I am looking at this business, and it is a fast-growing US-based warehousing and logistics service provider that offers comprehensive supply chain solutions, providing blah, 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 blah. All right, so if you are, imagine like Amazon. So Amazon doesn't make a lot of like net income. Let's put it that way, because they reinvest a lot of it. So it all goes out in expenses and things like that. However, when you look at the cash flow statement, let's have a look at that now instead of going to the balance sheet. When we go and have a look at the cash flow statement, we got our net income, which comes out. We've got some adjustments to it, but for instance, right here, this isn't in thousands, this is like in actual dollars, so it's like $2.9 million. So they made 3 mil and then 1.5. All right, and then purchase of property and equipment. All right, so they've plowed a lot into that. However, where Amazon, even in really early years, it was still making heaps of cash right here. So net cash provided by operating activities, this was its engine. This is where it had most of its money and it was growing. And it was able to plow pretty much all of this back into the business without needing to plow in a heap of debt or anything like that. So let's see, we've got cash, purchase of property and equipment. What? Oh yeah, 2.8 and 5.2 million across those years. And then loan disbursement amounts and proceeds from loans. Okay, so they're calling that investments. And then they've also got notes and things like that. So like corporate bonds that they've had to go and pay out, and then proceeds from convertible notes as well. So they've gone and got some more cash from that. So this business, when you look at, you're trying to look for businesses that are compounding and are going to compound into the future, you want to see that the actual product and the engine behind the main part of the business is growing, and it's able to do, it is an engine, it's working really well. And so this effectively is the engine that Amazon used for its like logistics business at the end of the day. And it was able to plow all its money into building out that infrastructure. And when you look at it, it is a very asset heavy business. But it's built that, and that's its moat, using it low cost. Because when you look at their margins, they look pretty thin, and that's by design. Now for these guys, I'm not really fussed. There is one thing though. So the business makes a little bit, all right? And when they had a good year, they made 18 mil gross. Then their general and admin was, fairly fixed. It's grown a bit. But they made a pretty decent net income. Now, if we go back and we have a look at what the business is priced at, this is the interesting part. So we have a business, the entire business, worth 13 million. What did we just see that it makes in cash? 3 million the year before, 1.5 million this year. It's still got a fair bit of debt that it's playing with and things like that. Now, to look at this in terms of if it's a value trap or not, you'd really need to do your deep dive to see if this business is going out the back door and going to have a bankruptcy and then get liquidated, or is there another opportunity where it's actually going to produce positive net income, which you'd really want to look at your quarterly results for the financials and things like that from these guys to see if they are, cash positive in terms of income for this year. And then we have what was it? This annual report came out in September last year, which we're almost in September now, in another month and a half. Or, yeah, a month, sorry. So that kind of means that if they do have some positive results, that could be a catalyst for the stock price to bounce back to reality, because at this stage, what's priced in? Well, it's kind of priced in that this stock is not doing too well at all, and that most likely it's going to go bankrupt and get liquidated. So that means that there's an opportunity for a savvy person, investor, that if you're looking around specifically at businesses like this, to look for opportunities, especially one that's got growing revenues, it's got enough debt, and it's putting stuff into investments to try and grow out its logistics wing. You'd really want to have a good idea on management though, because they can really turn that ship ass up pretty much, and then so let's go in summary. So Empress, interesting business, interesting stock. It might be a long-term change, but right at the moment it doesn't hit my criteria to have a look at. Bridger, aerospace, another interesting business, but at this stage just not really ticking the boxes for me. And then Logi Holding Corp, so logistics type business. It's really, it's more looking at the old school Warren Buffett looking for the cigarette butts on the pavement. You really want to have a look at this business. It's not my forte for this analysis and the aim of this channel. And what I'm trying to look for at the moment, trying to find the best stocks. But if you've got a savvy eye and you're looking at investments to try and cut your teeth on in terms of, value opportunities, feel free to have a look at this one, check it out, and feel free to chuck your little assessment or your quick couple of sentences in a comment below. So thank you for your time. Otherwise, we'll be back tomorrow running through the rest of that screen list and try and punch out some more reviews and stock analysis so that we can find the next big thing before everyone else finds it and it appreciates in value. And then it's kind of like, well, that was lame. You're just telling me the best stocks that are already the best. So let's get after it. Catch you guys tomorrow. And otherwise, check out this next video because YouTube thinks you'll like it. Cheers.